Hi, my name is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in today's episode, I want to go through some superannuation contribution strategies. As we approach 30 June, it's always this time of year we start thinking about, is there anything that we can do to minimize tax? And superannuation tends to be at the top of the list in terms of the most impactful way to minimize income tax. And I just wanted to work through 10 strategies, really like a checklist, if you like, for you to sort of think about. And I guess the first sort of point I'd like to highlight is that you need to be really careful about contribution cutoff times. So for a contribution to count in a particular financial year, it not only has to be received and receipted by the super fund, it actually needs to be allocated to your account. So what you'll find is that superannuation funds will have cutoff dates for contributions. Then it allows them the time, obviously, to account for those contributions and then allocate to one's account. So I tend to say, look, try and do all your contributing before 20 June. At least that gives you kind of 10 days, even if the cutoff time is after that. That's what I'd sort of aim for. And that's why, I think now's kind of a good time to start thinking about this so that you can get yourself in order and you've got about a month, 4 weeks or so to organize yourself to make those contributions. So the first one, tip one, concessional contributions. I mean, everyone's going to be most likely familiar with concessional contributions. They're the contributions that you can claim a tax deduction for. So you get a personal income tax deduction for. There's a cap, a concessional contribution cap of $30,000 for the 26th financial year. After 1 July, that cap increases to $32,500, but I don't want to confuse you. It's 30 grand this year. That 30 grand cap includes any employer contributions, so superannuation guarantee contributions that your employer has made on your behalf. So if your employer's contributed $14,000, then of course you've got about $16,000 left in the cap in terms of ability to contribute. Those contributions are taxed at 15% inside the super fund, so you don't pay any tax on that income outside super, and they're taxed at 15%. So if your marginal tax rate, so if your taxable income in fact is more than $45,000, then there's a substantial tax benefit for making those contributions. Unfortunately, if your income's above $250,000, your adjusted taxable income, you'll pay Div 293 tax, which means it's another 15% on the contributions. But even so, that means your contributions are taxed at 30%, whereas if you didn't make those contributions, if they were discretionary, that income might have been taxed at 47% if you're in the highest marginal tax bracket, so your taxable income is above $190,000. So still a 17% tax saving, notwithstanding you get some money in a tax-effective environment and you're getting to invest it as well, as opposed to taking it as cash salary and you might end up spending it. So if your income's between $135,000 and $190,000, your tax savings about 24%. So it shows the tax savings are substantial. And as I said at the opening of today's episode, be careful about tracking these contribution limits. It's really about on a cash receipt basis and when they're allocated to your account. So sometimes people get caught out with this. So if your contributions that related to, say, June 25, which is the previous financial year, not the one we're currently in, those contributions from your salary probably weren't received by the super fund until July 25. So that means they fall into this financial year. So sure, you can look at your pay slip and have a look at what contributions have been made on behalf of your employer. And that'll tell you, what's been paid out or gone through the payroll system, but doesn't actually necessarily tell you what's been actually paid to the super fund. Now, if you're with a large employer, they tend to make super contributions on a pretty rigid timeline. They might pay every month or so forth. With smaller employers, they can pay as least often as quarterly. So it can be a bit lumpy. So probably the best thing to do is check with your super fund to see how much in terms of contributions have they received this year. And then you've got to work out what the quantum of contributions or the size of contributions you're likely to receive between now and end of June. And then that way you can then work out your cap. Maybe build a little bit of a buffer in there so you don't breach the cap, maybe a couple of $100 or whatever. But you've got to think about what's been received in your actual superannuation account this financial year, as opposed to just following your pay slip. Now, Campbell made the comment about, making additional super contributions versus making home loan repayments in a discussion recently. And he made the correct observation that firstly, depending on your income, there's already a substantial tax savings. So that's an initial kind of bonus, if you like. And then secondly, you've got to weigh up what do you think your super fund will earn over the next period of time, or until retirement really, on an after-tax basis versus what is your interest rate. And, depending on your views around what the average home loan interest rate will be and what the average earnings inside super, the average earnings inside super over the last 5 to 10 years has been pretty healthy in the main. So, it's entirely possible that regardless of your home loan, assuming you've got the cash flow to do it, making additional super contributions is a superior strategy than preserving that cash and repaying or offsetting your home loan. Now, that's the financial viewpoint. Of course, you've got to think about, where that sits within your risk profile. Okay, strategy number 2 is catch up or carry forward concessional contributions. So this means that if your super balance at 30 June 25 was $500,000, $500,000 or less, you potentially qualify to use any unused concessional cap over the last 5 years. And you use the oldest unused cap first, and then you sort of work your way forward. So each year, a unused cap year drops off, and that unused cap year was 2020 to 2021, so the 21 financial year. Now, in the 21 financial year, the concessional contribution cap was $25,000. So if you didn't make $25,000 of concessional contributions in that financial year, you can use it this year. And of course, you can use 22, 23, 24, 25 financial year unused caps this year as well. So whether you do that really depends on your taxable position, expected taxable position in the 26 financial year, your expected taxable position the following year as well, and also your priorities, I guess. If we expect our client to crystallize some sort of capital gain or higher income, a bigger bonus or something like that, we might actually decide not to make any additional concessional contributions this financial year, preserve them and use the carry forward catch-up concessions next year and push them all into the following financial year. Or if we had a client that crystallized a large capital gain this year, we'd probably want to bring forward as many contributions as possible to reduce their taxable income. So it's a way of, you don't have to use them this year. Certainly the unused cap from the 21 financial year will disappear. So I would say that if it's material, use it or lose it. But in terms of using the full 5 year, just depends on whether your income's going to change and priorities and so forth. Conceptually, of course, if you haven't made any concessional contributions for the last 5 years, potentially you can contribute up to $167,000 in one hit. That's really the last 5 years worth of superannuation caps. Now, that's a rare situation, but someone, that is, under age 67, for example, that is a retiree that just sold an investment property. I know that's a bit of a convoluted example, but, that would result in a meaningful tax saving as a result of making all those contributions at once. So it's certainly something you want to think about. Also, the other thing to think about with respect to carry forward and catch up contributions is your super balance. So let's say your super balance was $490,000 at 30 June 25. Well, you're almost certainly over that $500,000 benchmark to be eligible to use catch-up contributions. So in that situation, this year is your last opportunity to ever use the carry forward concessional contribution limit. So we want to really think carefully. Similarly, if your balance is approaching $500,000 this year, and so by 30 June you think it's still going to be under $500,000 but pretty close, well, then the 27 financial year will be the last time you'll be able to use those concessional contribution limits. So it's something to really think about. You can check your carry forward contribution limits in MyGov. So if you've linked ATO to MyGov, you just go to super and then carried forward concessional contributions. Just be careful with that information. You might want to sort of double check it with your super fund and your accountant, but it should be recorded there. It will only be recorded if you've lodged your tax return, or I probably should say it's most reliable after you've lodged your tax return. So if you haven't lodged your return for, say, the 25 financial year, don't don't necessarily rely on the data that's in there until the actual return has been processed. Okay, the third super strategy that I want to talk about is contribution splitting with your spouse. That's separate to spousal contributions, which I will come to later on. But essentially, what you can do is after the end of a financial year, so you'd have to do it in July 26, you can move 85% of your contributions from your account into your spouse's account. And 85% obviously just allows for the contribution tax. Now, you can't do that really until the end of the financial year, or after the financial year, I should say, but it's something you might want to think about now, because you might say, look, I want to contribute into my account so I get the tax deduction and then move the money into my spouse's account. So why would you want to do that? Well, firstly, you might want to equalise superannuation balances as much as possible, both from a transfer balance cap perspective. So the transfer balance cap is the amount that each individual can have that's going to be tax-free in retirement. At the moment, that's $2 million as it stands today. After 1 July, it's $2.1 million. So by having spouses equal, we get to utilise those caps as much as possible. And then to avoid Div 296 tax, which is the new tax that applies to balances above $3 million. So again, if we have equal balances, we get to sort of maximise the tax benefits of super. If your spouse is older than you are, or vice versa, you might want to move contributions around. So if my spouse is older than me, I can move my contributions into her account and potentially access that sooner than what I'd be able to access my super. Or similarly, the other way around, if you think you're going to get the age pension, or someone does, then you can move contributions out of your account into your spouse's. If your spouse is younger, for example, then that will, your super is counted in the asset test for the age pension. So that reduces your assets, of course, and moves more into your spouse's name. But contribution splitting, certainly if you've got uneven balances, is something you might want to think about. No tax benefits, but really just some financial planning considerations. Okay, the fourth strategy is non-concessional contributions. Non-concessional contributions are really after-tax contributions. It's really like just moving cash savings into super. And remember, super's not really an investment per se. We shouldn't conflate it with an investment. Certainly we invest inside super, but it's really just an ownership structure. So we can think about non-concessional contributions, moving something from my personal name into super. It's really just moving ownership structure. Because those contributions are made on an after-tax basis, as in their savings you're entitled to, you've already paid tax on those monies, potentially, unless it was a gift, then there's no taxation consequences. So you don't get a tax deduction for it, but nor does the super fund get charged contributions tax on it. So there's no tax effect. It's really just about moving more capital inside a ownership structure that only pays 15% tax on earnings and 10% tax on capital gains up until you've got a balance of $3 million, of course. The non-concessional cap this year is $120,000 and is available to anyone that is younger than 75 and has a super balance, a personal super balance of less than $2 million. Now, if your total super balance was less than 1.76 million on 30 June 25, you can potentially bring forward and make 3 non-concessional contributions, or 3 years worth of non-concessional contributions in one go. So 3 times 120 obviously is 160. If your super was between 167 and 188 million, then you can bring forward 2 years of non-concessional contributions. It's also possible to straddle 2 tax years as well. So next year, so after 1 July 26, the non-concessional cap, the annual non-concessional cap increases, gets indexed to 130,000. So potentially if my strategy was to try and get as much money into super, I could make 1 year's worth of non-concessional contributions this year in June 26, and then in July 26, I could use the bring forward rule, assuming that my balance at 30 June 26 was less than 1.76 million. So assuming I'm eligible, I can make 3 years worth of non-concessional contributions in one hit. So 3 times 130, because the cap's going up, is $390,000. So potentially one individual can move between, over the course of June and July this year, $510,000 into super. Remember, these are strategies to really change ownership structure. And I've spoken plenty of times in the podcast, about making sure you make the most of your transfer balance cap. Again, the amount you can have inside super that doesn't attract any tax. And particularly for property investors, the challenge or the main consideration is, if I've accumulated a lot of wealth outside super, how do I get it into super? And a non-concessional contribution strategy is a way of doing that. Now, one little tip here that we've come across is that if you have breached your concessional contribution cap, remember that's the $30,000 that we can put in each year and claim a tax deduction for. Let's say one year I put in 31,000. What will happen is that the super fund will treat 30,000 as a concessional and they'll treat 1,000 as a non-concessional. And we might not realize that's how the super fund has treated it. And so when we come to thinking about this year and we go, no, we've not made any non-concessional contributions over the last 3 years, so it means I can put 3 years worth in this year. Well, in actual fact, I've already triggered or used part of the non-concessional cap in that previous year, and so therefore I can't go back 3 years. So it's a bit confusing, but the tip is, if you plan to contribute this year more than the annual cap, so you plan to use that bring forward contribution limit, make sure you check with your super fund whether they've recorded any non-concessional contributions over the last 2 financial years. And if they have, speak to them about what your cap is this year. And you just want to be careful there. We've been caught out sometimes where, because a client's breached a concessional contribution cap, it's triggered then a non-concessional contribution in a particular financial year, which then precludes us from using the full 3 years carry forward. So I just want to bring that to your attention. It's really complex, this superannuation contribution stuff, of course, and that's why it's important to get on top of it and important to leave yourself enough time to organise it all. Okay, the fifth strategy is government co-contributions. So if your taxable income this year is below $47,500, that's not a perfect number, I've rounded up, around about that limit, and at least 10% of that income is from paid employment or business, so you've actually been working, it's not just passive investment income, then the government will tip in 50 cents for every dollar that you contribute into super, up to $500. So therefore, if you put in a $1,000 non-concessional contribution, the government will put in another $500. Now, if your income is below $47,500, you'll get that full $500, but it's phased out up to about $62,500. So even if your income's below $62,500, you still might get some of that benefit, partial benefit, and you must be under 71 years of age to get that. So it's a bit of a free kick. It's not going to move the dial for anyone, of course, but if there's some free money out there, why wouldn't you take it? So if it's you or your spouse or someone in your family, that's working or has done some work and has a low taxable income, they might be a benefit from government co-contributions. Number 6 is downsizer contributions. So if you're 55 years or older, you've owned your home for more than 10 years and you sell that home, each person can contribute up to 300,000, so 600,000 for a couple, into super, and those contributions need to be made within 90 days of settlement. The downsizer contribution is in addition to the non-concessional contribution cap. There's no work tests and you can still do it even if your total super balance exceeds $2 million. So you don't need to downsize as in buy a smaller home. You just need to sell an eligible home to be able to make that contribution. So it's something to think about if it's going to happen in the future, because, in some circumstances, you might be better off to borrow some money today to try and get as much inside super. So for instance, if I had a client that was going to do a downsize strategy next financial year, I might try and find or borrow or somehow get $120,000 and make a non-concessional contribution this year. And then next year we'll sell the house so we can make 300 plus 130. And then in July 27, we can make another 3 times 130. So really it's a way of just trying to get as much money inside super, if that's the strategy, as possible. So don't necessarily want to think forward around, if that's the strategy, is get as much money inside super. How do you do that? And in fact, borrowing some money now to get that 120 inside super so you can, leverage the caps as much as possible. Could be, I'm not saying it's definitely, but could be a potential opportunity for you to maximize that. And with the downsizer and those rules, you could potentially get, almost almost $1.8 million into super over a couple of financial years, a few financial years into super, for someone that's going to complete a substantial downsize, that's a pretty good outcome. The other consideration is if you expect to make a downsizer contribution in the future, to what extent will that limit your ability to make concessional contributions? Remember, you can only make concessional contributions if your balance is below the transfer balance cap, which is $2 million today or 2.1 after 1 July. So if I'm going to make, say, 1.9 and I know I'm going to contribute 300,000 next year because I'm going to downsize, then really next year will be my last year to ever make any non-concessional contributions. So again, just thinking through the timing of all this and these contribution caps are really important from a financial planning perspective. I should say I'm trying to make this as clear as possible. The challenge is it's not really clear. It can become quite technical. So if you're ever confused, of course, just refer to the blog on the website. It's all there written there in plain English. And sometimes reading through these things at a bit of a slower pace can make a little bit more sense. I guess the whole point of today's podcast is to run through the checklist of 10 items we can think about. And then if any sparks some interest, of course, then you can delve a little bit deeper into them. Okay, number 7 is spousal contribution. So if your spouse earns less than $73,000 and you make a non-concessional contribution into their super account, you will receive a tax offset. This is not a tax deduction, it's a tax offset. Tax offset's probably worth more than a tax deduction, to be honest. And your tax offset, I should say, is equal to 18% of the amount you contributed. So if you contributed a full $3,000, 18% of $3,000 is $540, and so that's how much tax you'll save is $540. The spousal contribution is phased out at $40,000. So even if your spouse earns between 37 and 40, there still might be a bit of a benefit there. Now, this is a bit like the government co-contributions. It's not going to move the dial. It's not going to change any outcomes, but I guess it's one of these small wins that are available that we can, really think about and explore if they're relevant to our situation. A couple of words of warning. If we do that, of course, it triggers the use of their non-concessional cap. So if you plan to bring forward contributions in the future, just think about that because you do trigger utilization of this year's cap if you make that small contribution. And then, of course, the government co-contributions can be used in addition to this. So, if your spouse's income is less than $37,000, you could potentially make both a spousal contribution and a government co-contribution in order to boost their super. The two together, again, is not going to move the dial too much. You'll be about $1,000 better off, but $1,000 better off is better off in your pocket than the government's, of course. Number 8 tip is to use the small business CGT concessions that are available to, self-employed people. If they sell an active asset could be the business, it could be a commercial property that the business utilized at least 50% of the time that it was owned. So it's quite a broad definition. And, if you've made a capital gain that's linked to your business, it's something that you want to speak to your holistic accountant about. There's a couple of different caps here. We've got a lifetime $500,000 cap that we can contribute to super to make a capital gains tax liability disappear. Also, there's a retirement cap, and it was designed for people that were self-employed. Maybe over that time they hadn't contributed to super, that really their business was their nest egg, and it allowed them then to move that money into super. So the retirement exemption allows someone to move almost 1.9 into super. Again, these are separate to all the other caps that I've spoken about and available really just to self-employed individuals. So something to consider if, whether that's this year or next year, if you think you're going to crystallize a capital gain. Number 9 is for younger people, first home buyers looking to save for a housing deposit. You can use the First Home Savers Scheme, which allows you to salary sacrifice $15,000 a year to put into super, and you can accumulate up to $50,000 into super. So it's really just using superannuation as a savings account, if you like, and withdrawing it later on. It's useful, particularly useful for lower income earners in particular because of the tax tax benefits. Look, it's going to work at the margins, but a $50,000 deposit doesn't really get you very far in Australia with property prices, of course, but every little bit counts. So it's still worthwhile to think about, but if you're a first home buyer, using that first home savers scheme could be the way to go. It's really additional contributions, so it doesn't include your mandated employer contributions. It really is just a way to save additional monies in a tax effective way. And my last tip is for people that are already in pension phase or thinking about converting into pension phase. So the transfer balance cap, I've mentioned a few times, $2 million, it increases to $2.1 million in 1 July. It's a lifetime cap. So once you first start a pension, a retirement income stream, in that financial year, the cap that exists is the cap that you've got to live with for the rest of your life, although there's still debits and credits that can go against that cap. So I would much prefer to start a pension on 1 July than 30 June because my lifetime cap on 1 July is $2.1 million, which means I can get more money into super. Just a few observations with this transfer balance cap and trying to navigate it. For a lot of people, it seems logical that the longer I delay converting into pension, the better off I am because I'm delaying crystallizing my lifetime cap. That can be true, but also looking back over, client accounts, even clients that we converted to pension, many years ago, they still might have like $2.5 million in super because any future earnings on that balance, it's not a hard cap. It's just the amount that you've transferred into pension. So if I transferred, let's say $1.7 million into pension phase 5 years ago, if that 1.7 has earned some really good returns, it could be worth $2.5 million today. And I've got $2.5 million inside a tax-free environment. So sometimes delaying it really depends on what's going to increase faster, my super balance or the cap limit. And you've just got to really think carefully about that. The second observation is about withdrawing lump sums. When you start a pension, you have to take a minimum amount. So between 60 and 64, that minimum amount is 4%. Between 65 and 74, it increases to 5% and then 6% and therefore so on and so forth. And it's really just forcing people running down their balances rather than using superannuation as a tax haven. But that's the minimum. There's no maximum. So in order to preserve the amount of money or your transfer balance cap, you've got to take the 4%, that's fine. But if you're going to take a lump sum, what you're actually better off doing is commuting that lump sum back to accumulation. Because what happens is you've got a lifetime transfer balance cap. Let's say you started a pension this financial year, it's $2 million. Let's say you converted $1.7 million into pension phase. That means that your remaining transfer balance cap is $300,000, of course, because 1.7 versus $2 million, which means that you can put another $300,000 into pension phase if you wanted to through a non-concessional contribution. Now, if I want to take $100,000 out, if I just withdraw it out of my pension account, there's no change to the transfer balance cap. But if I commute $100,000, commute just really means transfer, $100,000 from my pension account back to accumulation, what happens is that's a credit towards my transfer balance cap. So initially I've converted 1.7, so my remaining cap's 300, but later on I commute 100,000 back to accumulation, so that's a credit back to my transfer balance cap. I now have $400,000 cap. So, and this is important for people that think they're going to sell an investment property down the track, that might use downsizer concessional contribution limits, really want to, I really think everyone should be wise to this to try and preserve as much room as possible to contribute or maximize the tax-free benefits of superannuation. There's lots of different reasons you want to do, even inheritance, you might receive inheritance, you want to put that inside super. If your spouse passes away and you want to keep as much of their superannuation account inside the tax-free, pension phase, it's really important to think about that. And Campbell wrote a blog in October last year, episode 376, around death benefit taxation. So the amount of tax that's payable when you pass away, and if your super then passes into your estate or to non-dependents, so typically adult children, for instance. So something to really think about there in order minimizing tax and a recontribution strategy, which was kind of the core of that episode. Now, a couple of other small little tips with respect to super contributions. If you have your own self-managed super fund, you can use what's called a contribution reserving strategy. Again, this is a bit technical and certainly you want to check with your trustee and your accountant and so forth. But if you expect to have a larger taxable income this year, it's entirely possible that you could make 2 lots of 30,000 contributions before 30 June. And one contribution would be allocated to your account and the other one would be allocated to a reserve. So it's not allocated to a member yet. And by doing that from an income tax perspective, so you personally, you can claim 2 lots of $30,000. From a superannuation perspective, because only one has been credited to your account, one contribution, then you haven't breached the cap. And on 1 July, the other contribution will be credited to your account and would count to next year's cap. So this is an opportunity for someone, firstly, that doesn't have or can't use carried forward concessional contributions, either because they've used prior year caps or their balance is over $500,000, but wants to try and get as much tax deductible money into super this year because they've got an unusually large taxable income. Unfortunately, this is going to only be used for self-managed super funds. So I just want to throw it out there, but it's worth a mention because it can be used in, certain circumstances. Also, just as a note, Div 296 tax, which is the new 15% tax or 30% tax over 10 million, but 15% over personal super balances more than $3 million. That begins on 1 July 26. So the 27 financial year is the first time that tax is law and will be applied. I will most likely do a podcast episode on it because, I think we need to dig a little bit deeper in it. And there's some planning opportunities, I think. It's about maximizing super, but not putting all your eggs in one basket, but just highlighting that happens. And there's an opportunity there to reset cost bases on investments that just relate to the Div 296 tax. So if you're going to be caught by that tax, that's one of the things that, and you don't need to do it now. If you've got a self-managed super fund, you've got until when you lodge your 26 tax return, I think, but it's an opportunity to reset cost bases just to minimize the impact of that tax. Now, most of these superannuation strategies aren't new. They've been around for a while. Of course, the caps change each year, and of course, your personal circumstances might change as well in terms of what your tax position is this year, what you expect it to be next year. How does it fit within your long-term investment strategy as well? But always good just to run your eye over these 10 strategies to see if any are utilized this year. I guess as we approach 30 June, just a couple of points to summarize. Confirm what your concessional contributions will be this year, what you expect to be. If you're a PAYG salaried employee, you need to work out what contributions will arrive to the fund, remembering that contributions that are deducted from your salary in June might not necessarily arrive in your fund this year, so it won't necessarily count. So just check with your super fund as well. Check concessional contribution thresholds, also what your super balance is at 30 June 25 and what it will be at 30 June 26. And just see, can you use those bring forward concessional contributions? Is it the last year? Can you make non-concessional contributions? Is it the last year? Can you bring forward all these sorts of things? If you're going to make contributions, get them in by 20 June. If you do a little bit after that, you're probably going to be okay, but I think sooner is better than later. If you do make personal contributions that you want to claim a tax deduction for, so concessional contributions, you need to complete what's called a notice of intent to claim a tax deduction. Your super fund will provide that. Important to complete that and provide it to your accountant so that they make sure that those contributions have been classified correctly. And if you're going to use the contribution reserving strategy that applies to self-managed super funds that I just spoke about, you need to also lodge an additional form with the ATO. Of course, all this information is general in nature. It doesn't take into account your personal circumstances, and superannuation laws are very complex. So always best to double check with your accountant or your advisor before acting on this information. Okay, let's leave it there for now. Next week, I've got a really interesting episode, I think, which leverages off some of Charlie Munger's best advice, which was Warren Buffett's late business partner. And also next week, I'm going to announce how you can pre-order my new book, Wealth by Design, as well as a pre-order bonus. So look out for that. Until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify. as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.